Welcome to Dr. Fred Markets. This is not financial advice. While most people scroll past the noise, a few take the time to understand what's really going on. Finance, crypto, artificial intelligence, this is where it all connects. You made the right choice being here. Let's dive in.
You're betting on Nvidia, but the real AI stock is a 4,000-year-old bottle of booze. Bitcoin up 2.6% today, Ethereum ripping 5%, S&P 500 basically flat, Nvidia red. That's the surface. Underneath, a much older asset class is doing something wild. The index that tracks investable fine wine is up roughly 300% over the last 20 years, with lower volatility than the S&P and bonds level drawdowns. And then there's whiskey. Rare cask and bottle indices have posted double-digit annual returns for over a decade, while your favorite growth ETF spent years round-tripping its gains. Here's the part nobody on FinTalk explains. These weird, quiet markets trade on a completely different clock from your Robinhood app. They don't care about today's CPI print. They care about harvests, scarcity, and human flexing behavior at rich people weddings in Lake Como. Now connect that to crypto. Bitcoin is green today, but zoom out. It spends long stretches going sideways or bleeding 70 to 80% after blow-off tops. Ethereum does the same dance in 4-year cycles. These are not investments. These are leveraged opinions on human mania, which sets up the tension for you. You're trapped between two scams of time. On one side, hyperliquid dopamine machines like BTC and ETH that beg you to panic trade every tick. On the other, slow out, illiquid status assets like wine and whiskey that rich people quietly use to store and flex wealth over decades. Here's the punchline. One of those markets is engineered to extract your attention. The other happily ignores you and just compounds in the background. Most people assume alternative assets are a meme or a rich guy toy. Reality, there's a boring mechanical reason fine wine and whiskey behave like this. They have 1. Shrinking supply. Every time someone opens a bottle of 82 Lafite or a 30-year single malt, that investment universe permanently shrinks. 2. Growing demand. Global middle and upper classes keep expanding, and status signaling never goes out of style. 3. Zero dilution. Shadow X doesn't print new vintage 1990 shares when the price goes up. Bitcoin has a cap. Fine wine vintages have a smaller one. Now take today's AI-adjacent noise. Largest digital camera ever is about to survey the universe for a decade, feeding petabytes into data centers, training models, juicing chip demand narratives. You know what that does? It makes every trader stare even harder at their screens. More charts, more plays, more churn. Meanwhile, the guy who bought a diversified basket of investment-grade Burgundy in 2014 forgot the password to his wine portfolio app and still beat your "I watch markets all day" performance. Cliffhanger. The evil truth is that attention is the most expensive asset you own, and you're lighting it on fire, watching every Bitcoin candle while an entire asset class quietly pays people to be bored.
Does what you just heard make you want to dig deeper? Good, because that curiosity is exactly what brought you here, and the second part is going to take it further. Let's go.
Here's the connection nobody spells out. Crypto and fine wine whiskey are both stories about belief and scarcity, but they invert the risk. Crypto gives you instant liquidity with weaponized volatility and narrative whiplash. Wine and whiskey give you near zero day-to-day liquidity with returns driven by slow demographic and cultural shifts. One is a casino that wears a future of money hoodie. The other is a museum that charges a cover to rich people who want to drink their art. Smart money doesn't treat them as enemies. It uses them as opposing gears in the same machine. High volatility, narrative-driven exposure, Bitcoin, Ethereum, for asymmetric upside during mania phases. Low volatility, scarcity and status-driven exposure, fine wine whiskey funds or platforms to smooth the ride and quietly store value while you wait for the next mania. You don't learn this in index fund sermons because it breaks the just buy VOO and shut up religion. But look at the math. Historically, adding a 5 to 10% slice of wine whiskey exposure to a standard stocks bonds portfolio reduced drawdowns and kept or improved returns. Why? The price doesn't care when the Fed opens its mouth. It cares when Asia's rich decide Bordeaux is sexier this decade than Napa. Practical action if you're not a millionaire with a cellar in Bordeaux. 1. Learn the mechanism. Look up historical charts of the LivX 1000 fine wine and major whiskey cask indices versus the S&P, Bitcoin, and gold. You'll see 3 different time signatures of risk. That awareness alone makes you trade crypto less stupidly. 2. If you touch these markets, avoid tourist traps. Skip influencer, cask syndicates, and meme bottles. Stick to regulated platforms or funds with real custody, transparent fees, and focus on blue-chip regions, Bordeaux, Burgundy, high-end Scotch. Treat it like buying an ETF, not a flex on Instagram. 3. Build a boredom allocation. Decide in advance. X% for high volatility belief assets, BTETH, Y% for slow scarcity assets, wine, whiskey, and I don't touch them for 5 years. You stop treating crypto like a scratch-off ticket and start treating it like one gear in a bigger machine. This is not financial advice. It's a jailbreak for your attention. You learned one thing today. There are assets that pay you to be bored. You saw the mechanism. Shrinking supplies, growing status demand beats your day trading muscles. Your move now, decide how much of your life you want priced in red and green candles versus dusty bottles aging in someone else's cellar. If you want more of this ruthless, no myths view of markets, you know what to do. Subscribe or go back to refreshing your crypto app every 6 seconds and calling it research. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.